Hello, it's Tom Siomades, Chief Market Economist here at AE Wealth Management. It's hard to believe 2025 is in the books already, but then again, we say that at the end of every year. Today, however, is not a day for philosophizing, so let's quickly recap last year and talk about what we might expect as we start 2026. 2025 turned out to be a pretty good year for the markets, with the major indices returning over 15%. The year, however, was far from smooth. There was a lot of excitement and expectation as the new administration took office and moved with lightning speed. There was a flurry of executive actions undoing things the previous administration had done, plus a ton of new stuff which was promised during the election. Suffice it to say it was a whirlwind, one which continued for much of the first half of the year. That was to be expected. What was not expected was the broad sweeping tariffs which were announced in early April and sent the markets plunging. Although President Trump used tariffs during his first term, the markets did not expect or fully comprehend the magnitude of what Trump proposed this time around. After a month of pain, the tone from the administration eventually softened, helped along by the bond markets, which were signaling severe implications for the global economy. Some deals were announced, and the most onerous sanctions were postponed or lowered. Markets calmed down and rebounded in response. We also still had the Department of Government Efficiency, or DOGE, tough talk on China and political bickering. But the markets expected that, and we made it all through the first half on an upbeat note. The first half of 2025 was really a tale of two quarters, with the first quarter starting really strong and losing steam into the beginning of the second quarter. Then just as quickly, markets accelerated again to end the first half of the year. GDP came in at a negative 0.6% in the first quarter. A bit fluky because imports were running much higher in advance of the tariff announcements. But it bounced back in Q2 to 3.8% to even things out. We finally received Q3 GDP late in December, thanks to the government shutdown supposedly over Obamacare subsidies. But growth was strong again, and I expect Q4 GDP to continue that trend when it is announced in the early part of 2026. The next big item on the agenda after the tariffs was the massive One Big Beautiful Bill, which President Trump signed on the 4th of July. The most important part of the bill, in my opinion, was the preservation of the Trump tax cuts from his first term. Had those tax cuts been allowed to expire, we would have reverted to the old tax rates and been hit with a massive tax increase. Markets had largely priced in the bill as we notched fresh records through the summer. Grumbling began to circulate throughout the summer around rate cuts. The Fed had been mostly a spectator for the most part thus far, and there had been no rate cuts since December of 2024. The markets began to take notice, with inflation stuck at around 3% and the jobs picture softening. The Fed was straddling a fence, with markets and weak jobs numbers calling for rate cuts, while stubbornly stuck inflation argued against them. The Fed finally relented, cutting rates by 25 basis points in September and again in October. But Fed Chair Powell threw cold water on a third cut in his press conference in October. With the aforementioned 43-day federal government shutdown in full swing, the lack of economic data, and markets being viewed as overvalued, we had our second major decline of the year. As the shutdown ended and the government returned to normal, the Fed's stance seemed to soften, and they ended up doing one more cut in December. The Fed drama isn't over. It will continue into 2026, but more on that in a minute. Ironically, 2025 earnings have been really good despite all the headwinds and headlines, so maybe the criticism of overvaluation was not warranted. High-flying AI and tech stocks were responsible for a major portion of the most recent sell-off in November. Markets rebounded as we ended the year, buoyed by a strong Black Friday, Cyber Monday, and holiday shopping season. Although customers are a bit grumpy, all of us everyday Americans are looking for some positivity during this holiday season and upcoming new year. It was a highly turbulent year for the markets overall, but in the end, the year was a favorable one for investors. However, 2025 was not a good year for those with a fickle heart, and there were plenty of opportunities to throw in the cards and call it quits. If you stuck with your plan and were disciplined, you may have realized a double-digit return. I know it wasn't easy, but in the end, it was worth it. Unfortunately, I'm not looking for 2026 to be much calmer either. Let's take a look at how things could play out. First, some accountability. Last year, I predicted the S&P 500 to close out 2025 at 6,600, and it closed a healthy amount above that. But better to underpromise and overdeliver on the upside, right? I had predicted a low of 5,900, and we actually dipped below 5,000 briefly during the worst of the April tariff-induced panicky sell-off. The run for the fire exits was something I did not foresee. On the bond side, thanks to the final rate cut from the Fed, my prediction of a Fed funds rate of 3.5% was spot on. Unfortunately, the 10-year has not fully cooperated. Remember what they say about a blind squirrel. Okay, now that that's out of the way, let's get back to 2026. I'm expecting GDP to continue to expand as deregulation and investments take hold. The first order of business this January is going to be a potential government shutdown. I'm not expecting civility to miraculously spring up in Washington, D.C. In fact, I expect it to ramp up since we will be having midterm elections in November. Midterms are generally bad for incumbents, and affordability seems to be the issue taking shape for this election cycle. Each party has its own idea how to tackle this. If Trump manages to land the plane with his policies of deregulation, investments, lower energy prices, and interest rate cuts, while making consumers feel things are getting better, there will be less appetite for change. But if people feel things are still the same, the incumbent party will likely be ousted. The first 3 quarters of 2026 will be a fistfight for who's delivering and making improvements or who can provide better solutions. As such, the market will react to each proposal and development, and that will probably mean more volatility. Divided government is best for markets because that means there will be fewer big things coming from Washington for markets to navigate around. Politicians will spend their time fighting each other and leave the rest of us alone. With no big new programs, markets will be calmer. Last I checked, both parties are mostly all in on their version of bigger governments, as evidenced by the massive debt. Best to let them fight and disagree so we can make money. Some additional themes we will see next year and beyond. AI is not going away. In fact, adoption will accelerate. Companies that can turn AI spending into earnings and market expansions will propel markets forward. AI will continue to be a key driver for select technology, semiconductor, and real estate exposures. Big tech will get bigger. Next item we'll see is tariffs. Tariffs and trade barriers and supply chain diversification are now the new reality and will raise costs for some inputs while supporting regions that are dynamic enough to capitalize on new manufacturing and investment opportunities. Globalization is losing ground. The next thing up is the Fed, the European Central Bank, and Japan, who are all likely to follow different policy paths in 2026 as they respond to distinct growth and inflation conditions. World economies are not as closely linked as they were before, and therefore have many different dynamics. There may be more opportunities to take advantage of those dislocations as they arise, and the international allocation of your portfolio will take on more focus. Finally, on both a social and economic level, expect the gap between rich and poor to continue to widen. The gap between stronger and more stretched households remains wide, with asset owners and fixed-rate borrowers in a different position than renters or high-debt consumers. This will not only impact politics and policy, but will also affect which companies will be successful versus those that will struggle to maintain profitability. Now let's get to my favorite part, my predictions for 2026. First, let's address the elephant in the room. Sadly, I can predict with 100% confidence that the Kansas City Chiefs will not be in the Super Bowl this year, which will make my AE management colleagues very mad at me. More importantly for the rest of us, I can make a strong case for the S&P 500 ending at 7,700, and also to dip to about 6,500 sometime during next year. The headbutting between Trump and Fed Chair Jerome Powell will likely come to an end in May, when Trump replaces Powell with someone more to his liking. With that said, I expect to see the Fed funds rate sinking close to 2.5% as the new Fed chair cuts rates aggressively. Right now, however, markets are not betting that the 10-year will go that low. But I'm also thinking that they're underestimating Trump's influence on the new Fed chair. Please remember my forecast is informational and is meant primarily for conversational purposes. I do not have any special access other than my informed observations. Also remember that we still have the rest of the world out there. A year is a long time, and it is entirely possible that something unexpected can always materialize. One look at the tariff dust-up and the government shutdown is enough to convince me. Also, bear in mind that you have a plan and a team behind that plan who will help you execute it. Again, be patient and do not give in to emotion. I will be back with you in 3 months, and we can look back on the start of 2026 to see how closely we're tracking. I will tell you once more to review your goals with your advisor and make sure you're on track. Rebalance back to a risk tolerance that you're comfortable with. The start of the year is a perfect time for this exercise and will leave you with a sense of calm that your plan is up to date. You will also know that you have included all the recent and relevant information as you make your decisions and adjustments. I believe 2026 will be another good year for the market. But as always, there will be challenges. We'll see how we're tracking and how close our estimates of the markets and the economy were, and if we need to consider any new developments at the end of Q1. There will always be something new that we'll have to factor in. Happy New Year, and here's to a strong start to 2026. Have a great year. Please reach out to your advisor if you have any questions. Thank you.